Hi, welcome. We're on day 2 of our live tax and asset protection event here in beautiful Las Vegas. And if you're the type of investor who's kind of gotten a little bit of a nest egg and you're really ready to accelerate that investment and grow it exponentially, well, we've got a treat for you. I'm here with Rod Zabriskie from Money Insights. So welcome.
Thank you. Glad to be here.
Yeah, so why don't you tell us a little bit about you and Money Insights?
Yeah, so I'm president of Money Insights. We've been around for about 10 years. So my partner Christian and I started the business in Utah, but we're a virtual office. We have people all across the country. And we really do 3 things. So the first thing is we help teach people about investing in alternative assets. So that could be real estate, that could be funds, notes, business, all kinds of different things. Basically anything outside of Wall Street, stock market. Secondly, we have some sophisticated life insurance strategies that we use to help people accelerate and enhance the investing they're doing. And then third, we connect investors with investment opportunities.
That's awesome. So your background is in insurance.
Yes.
And what sort of made you go in this direction?
Yeah, it's a great question. So we had the opportunity to kind of narrow our focus, because like you say, we started on a more broad spectrum. We were working in our local office in Utah, and then we had the opportunity to start working with people across the country. And really what we found is that people who are kind of see the light as kind of moving away from traditional investments and moving more towards the alternative side, they need guidance, because the loudest voices out there are telling you everything you need to know about putting money in your 401k or investing in the stock market, but there's not as much out there about how to effectively invest in real estate and efficiently move your money in and out of those deals. And so those are the things that we're doing, and we're implementing those strategies with people, but then they don't have a lot of guidance outside of that. Like their local broker isn't selling real estate, right? They're selling the stocks and bonds and mutual funds, and so that's all they're offering them. And so there needed to be a bridge for people to be able to kind of cross over and get to really where they feel like they're efficient and effective in their investing. And so we have a lot of content out there. We have a podcast, a lot of YouTube videos and different things to help people be able to get that education. And then so by the time they plug in and start doing it, that they have a much better direction than they otherwise would.
Yeah, I love that, because at Anderson Advisors, Toby, our founding partner, is always saying we're an education company first.
Yeah.
And yeah, of course we offer tax, legal, business services, but it's educating investors and wanting them to do well that really just benefits everyone. So
Absolutely.
What are your main services?
Yeah, so when you boil it down and you say, someone plugs into, maybe they're listening to our podcast and they get interested and like, okay, yeah, I want to start doing this. I would say one of the first steps is what we call our investment optimizer. And so what we're doing is, because in most cases what people are doing when they invest in real estate, for example, they build their opportunity fund in like a savings account or money market. They take that money, they go out and invest. That creates some sort of cash flow coming back. They just flow it back in the savings account, build it up, and do it again, right? Go invest in something else.
Yeah, that takes so long. You're making like $200, $250 cash flow maybe per property. That just takes forever.
It does, yeah. And so it would be nice if as you received your monthly income, you could just immediately go and invest in something else. But you're right, that doesn't work out that way.
That doesn't work.
Yeah, it doesn't. So you have to build it back up, and it takes time. And the reason we choose a savings account is because of the safety and the liquidity. But it's very inefficient, because when you're between deals, it's just sitting there. And
doing nothing.
It is, yeah. And what we find is people get antsy about that, and so they make poor decisions just so they can get that money working for them.
They take on more
quickly.
risk because they want that reward faster.
Exactly. So with this investment optimizer, what we're doing is we're substituting out the savings account and using a specially designed life insurance policy, life insurance of all things, but doing it in a way to where we strip out all the costs as much as we can, so that we can make the asset, the cash value, as high as possible. So it's the same thing you're doing with a savings account. You put the money in, you build this account, and then when you take and go out and invest with it, what's cool about it is you're not taking your money out of the account. It stays there. You take a loan against it. Your money stays there. The loaned money is what you go out and use to invest. You create that cash flow, you flow it back. Technically speaking, you're paying down the loan, but strategically you're replenishing the opportunity fund, so you can go back out and invest in something else. So it's the same flow in and out of the deals. But while it's there, the reason we choose that is because it has very consistent return, 5% plus.
Okay.
And that return is tax-free because in cash value in a life insurance policy has tax benefits. And then this kind of unique ability to leverage against it. So then you literally have money working for you in two places at the same time.
So it's kind of like if you were to have a property and you took out a line of credit or a HELOC and then use that to invest somewhere else, except that the underlying asset isn't a house.
Right.
It's a life insurance policy.
It's very similar. Yeah. And so the difference here is that it's just like this liquid asset that's sitting there. And so there's not a concern about like a 2008 type of scenario.
Right.
There was nothing that was shutting down that line of credit to access for the life insurance policy.
That value is not going down based on other market fluctuations.
Right. Yeah.
Okay, do you need to have good credit to be able to qualify for this loan out of your policy?
No, because the beauty is that money that's already in your policy, because that's the collateral, they don't need to know anything else. They don't even ask what you're going to use it for or how you're going to pay it back.
Oh, that's nice too.
It's completely up to you. You can build that unique to whatever you're doing. So what I suggest is if I'm using that and going to go buy a piece of property, for example, and that creates a monthly income to me, I just take that net cash flow and I just flow that back towards it. That pays the interest. That makes it, and that's one of the cool things too, is that because I'm flowing that in and that's where I'm covering the interest, I pay simple interest on my loan, but the asset, the cash value, it's growing on a compounding basis. So we create this really cool arbitrage between paying simple and earning compound. Yeah,
just all in a circle, so you're like, we're not really having to think about anything.
Yep.
So then your second service that you guys really push, how is that the next step?
Yeah, so the capital avalanche is usually something that, again, especially for these people who are and want to be investing in alternative assets, so they have real estate, maybe they've invested in some syndications or in their own or somebody else's business, and they're kind of diversifying in different ways. So what the capital avalanche is we're using the life insurance as an asset, building towards this point where we can use it as a tax-free source of income in retirement. Okay. And as with anything, as with your business or as with real estate, if you can use leverage, use the bank's loaned money to help to fund, then you can do a lot more with it.
Yep.
And so that's what we're doing here. So we're building this asset for this future purpose of tax-free income, but the majority of the money going into it is actually coming through loans from the bank. So you're putting some money in, we're using that as the baseline, set up that line of credit, and then we're using the line of credit to continue putting money into it. The asset gets bigger, the line of credit gets bigger, I do it again. Asset gets bigger, I do it again.
And then the asset that you're putting money into, what is that asset made out of?
Yeah, good question. So it's a combination of two different types of life insurance policies. Okay. And we don't need to get into too much detail here, but whole life and indexed universal life are the two kinds that we use. One of them, the whole life side, is very consistent, very predictable in the way it grows. But it's not doesn't have as much upside opportunity, whereas the indexed universal life does. So we're kind of balancing those two with each other. But the point is that the money goes in there, it has this cash value, it's now earning and growing. I mentioned earlier that kind of 5+%, so 5 to 6% on a consistent basis, it's growing over here. And it's outpacing any interest that we're accruing on the loan. So we're creating this spread between what you're earning and what you're accruing in the interest, and over time that makes a big difference.
Yeah, is that still happening with the current market where interest rates have gone up and the stock market's maybe a little volatile?
Yeah.
Does that still hold true?
Great question. On a year-to-year basis, there may be times where we don't create that positive spread, but when you spread that out over time, what's interesting is a higher interest rate does push the rates higher on the loan, so that has happened. But what it also does is it pushes the rates higher what you can earn in the asset. So they don't necessarily move in lockstep, but on average,
it's still
you end up
up
with that positive arbitrage.
That's great, because we always say when you're in the market, it's a marathon, not a sprint. So you're doing that slow, steady, like late 1900s, as the kids say, strategy. But then you're also able to pull things out and sort of scratch that itch of wanting to do something different or getting diversified or doing something that's going to have more returns a lot quicker.
Yeah. So what it often looks like is that this person who is investing in these different things, maybe they'll have a liquidity event. And right now is actually a really good example of that. Let's say you've invested in a syndication or something, and then you have a liquidity event. $100,000 just landed in your account. and you're looking around and you're like, I'm not as excited right now as I was
Right.
2 years ago, 3 years ago about those opportunities, this is a good time to be putting it into something like this. Because, I mean, let's face it, when times are really good and they're really excited to get into the next deal, putting it here is not their first choice. But right now, that's
Right
actually...
now, it's a great option.
It
Yeah.
is.
So when you say it's tax-free income later, how does that work?
Yeah,
How
great
do you
question.
turn life insurance into income?
Yeah, that's a great, and that we get asked that a lot. Well, I mean, life insurance of all things, why are we choosing this
Like
as
usually
the
you have
asset?
to do something pretty drastic, like die.
Yeah, yeah, and that was my starting point too.
Uh-huh.
Like, well, life insurance is for my family if something
Yeah.
happens to me, right? So, it's evolved over time to be what it is now. But ultimately, when the income tax was first introduced, it was they created a bunch of different exceptions, right? You getting an exception if whatever you're paying interest on your home, or the tax
Schedule
credits and all
A.
these different things. Well, life insurance was one of those. They wanted to incentivize people to have life insurance. So they said if you have money in a life insurance account and it's earning and growing, you don't get taxed on that.
If you take it out.
Okay, so that's a good question. So technically it's called tax deferred.
Okay.
So you don't get a 1099 each year as it's growing. And then when you're ready to use it, we're actually using loans against it.
Gotcha. So
If
you're not
you- 'cause
actually
if you did
taking
take
it
it
as
out,
income.
Then you would get taxed on the growth side. But because you're using loans, there's no taxation with loans.
And the account is earning enough that it's able to pay back those loans without you having to
Yeah, so
use that same money.
yeah, that's a good example. So in retirement, when we're taking that income out tax-free, we're using loans. So you think, well, now I have this loan
Now
out here,
you have
don't I
a
have
debt.
to pay it back? Well,
Uh-huh.
yes, you will pay it back when you die, the death benefit.
Ah.
So income tax-free death benefit pays off that loan. And so it's not even that you're passing this tax burden on to your kids or something like that, right? Like it gets taken care of with that death.
I love those
death
kind of
benefit.
debts.
Yeah.
You don't have to worry about.
Yeah.
It's not my problem anymore.
Yeah. And one other thing, so I touched on this index universal life, and it is kind of linked to the stock market, but you're not investing in the stock market.
Okay.
So the beauty of it is that when in years, so let's just say we're using the S&P 500 as our index. In years where that is up, we participate in the gains up to a cap. Years where it's down, we don't participate in the losses. We don't earn any interest in that year, but we don't have to participate in the downside. So we kind of have that downside protection, participate in the majority of the upside, and that's why it creates that consistent growth over time.
So I've got a financial advisor, and my parents had a life insurance policy for me that they took out when I was just born.
Okay.
And he advised them, just gift it to her, let her take the cash value, because it's whole life and it's not a great product out there or investment opportunity. So with people in other areas saying those kind of things, what do you have to say in response to that?
That's a great question. And I would say that what we're doing, I'm using the words whole life, right?
Right.
So you would think, well, it's got to be the same thing.
Yeah.
But it's the way you build it. So what most people are talking about out there, the gurus out there that say, run from it, they're talking about something that's really basic, and you're putting money in. It takes a long time to start growing, and over the long term, you might earn like a 2 or 3% IRR on
Yeah,
that,
exactly.
right? So, but with what we're doing is, I mentioned earlier, we're keeping the cost as low as possible. We're overfunding it. We're putting a lot more money into it than you have to for the sake of the insurance. And again, you might say, well, why would I do that? The answer is because you want these benefits that I've been talking about, a 5+% tax-free return, the ability to access it and use it. And then, so I'm always careful to say with like, especially the investment optimizer strategy, the whole life policy doesn't become the investment. It becomes a vehicle to make the flow in and out of your investments more efficient.
Gotcha.
And then on the capital avalanche, yes, it becomes the asset that we're using, so quote unquote the investment, but the more important part is the leverage. So we're turning that 5 to 6% return into more like a 12, 13, 14% IRR to the individual because of the leverage.
I mean, who wouldn't want that?
Yeah, tax-free.
Right, exactly. So is there a threshold of income that you have to have in order to start that's like, who's the ideal person to get into this?
Yeah,
type
great
of thing?
question. So when we talk about the investment optimizer, so this is the person who's investing in the real estate or whatever and moving the money through the policy, there's really not a minimum. We'll personalize it and customize it to the individual.
Okay.
So at that point it just is, okay, what's meaningful? Or maybe put a different way. So me personally, all the dollars that I'm going to put into my investments, I want to put into my policy first because I want that efficiency. I want that extra layer of profitability that I'm able to create on all those dollars. So that's really how we design it. Whereas most people, they think, well, life insurance means I have to come up with how much insurance I want.
Yeah.
We reverse engineer it.
Gotcha.
We say, how much are you going to put in? And we will build it so that we have as little insurance as possible while still getting all those tax benefits.
Still getting the benefit.
Then on the capital avalanche side, the minimum is $100,000 initial contribution. And
that's all you need to start, because after that, the line of credit then pays for the premiums as you go forward.
Yep. Yeah, and then if you're adding more later, it doesn't have to be always 100% or $100,000 increments. That initial has to be $100,000 just to get over that initial threshold. And beyond that, then you can add in whatever increments you want.
Since it's linked to insurance, is age a factor? Is health a factor?
Great question. So the answer is yes. Age matters, health matters, but it's not as big of a deal. Like if I was talking about just a pure term life insurance policy, and I'm looking at someone who has like the best health rating versus a standard rating or something, there is a dramatic difference in those costs. But in this case, I mentioned earlier, we're overfunding it as much as we can, right? So because of that, the actual insurance part of it is pretty minimal. So does it make a difference if you're 40 versus if you're 60? A little bit, but not nearly what you would think. And then health-wise too. So you have to be healthy enough, like
enough to get the insurance.
Yeah, if you're in the middle of cancer, then they're not going to write a life insurance policy on you. But in those situations, you can write insurance on your spouse, your kids, business partners. So that's not, in my experience, that for most people hasn't been a roadblock we can't figure out.
I'm glad you mentioned that, because I actually read your bio, and you have 7 kids.
I do.
I have 6 kids, so between the two of us, we have like a couple of sports teams here.
Yes.
So do you do this with your own kids? Do they have their own policies?
Yeah, great question. So there are a couple of different approaches we see with that. So when I think of it like for the benefit of the kids, personally, I've just incorporated that in with my own policy. So anything that I'm using on their behalf, I've done my own. But I think eventually what I'll do is, as they're adults, so our oldest right now is 25, our youngest is 10.
We're in the same boat.
Yeah,
oldest 24, youngest 7.
Okay, perfect, yeah. So we do have a lot of people who will start writing policies on their kids while they're minors. And then we have a lot who will write more when they're adults. And so, but again, it's up to the individual, because if instead we have people who are like, oh no, I want to start building this nest egg for them, so by the time they get to the time where they're ready to buy their first house, they're ready to start investing, I'm going to use that as a tool to help teach them all the kind of tricks of the trade, and this is one of them to do that. So we do have a lot of people who put them directly on the kids.
I know that's a big strategy on how to pay your kids and how to get them set up right, because when you're a young investor, you have a different mindset, and then when you have kids, when you have family, that mindset shifts so much. So this is a great opportunity, and I love how you can customize it to where they are in life, what their goals are, the level of risk, all those things. It's amazing.
And just like this whole idea of overfunding creates flexibility. So if someone says, hey, I want to put $100,000 a year aside for my investing, and we're building that to put into the policy, they're not committing to $100,000. They have what we call a funding range. It might be something like $25,000 as a minimum, up to $100,000 a year as a max. So there's a lot of flexibility in how it can be built as well.
That's great, because it can be feast or famine, right, in investing, and so you don't want to get locked into something that where 5 years you got to put the same amount of money and you're not sure you're going to have that liquidity based on everything else. That's amazing. So if someone wants to get started with you guys, how do they do that? Yeah,
so we have a few things they could do. So if they want to just start like dipping their toe, we have a podcast. It's called the Money Insights Podcast. So you can find it on any of your platforms. We do a lot of content. So my first point I mentioned is we teach people how to invest in alternative assets. So we have a lot of content out there about that.
And that's all free teaching.
Yeah, we don't charge for any of that. We want people to be able to plug in and have a starting point. If they're brand new to this whole idea, there's a starting point. If they're deep into it, they're going to find a lot of great content that'll help them kind of build around what they already have. So on our website, moneyinsightsgroup.com, you can check us out there. So that's a good way to start. We have a lot of good webinars there. If the investment optimizer is intriguing, we'll go check out the webinar that we have there, and you can see us putting some numbers to it and playing it out over time. Person A who's using the investment optimizer versus person B who's just running their money through the savings account. So we have a lot of different ways that you can plug in and learn about it. And then, working with us typically looks like someone having checked out some of that content. They're like, oh, it'd be interesting to have a conversation. And so then we'll set up like a 30-minute.
Yeah, I saw on your website you could just click and get a free 30-minute consult. Just talk to you, get on your calendar.
Yeah, so we learn a little about the person, what they're looking for. We answer any high-level questions they have, and then we just kind of build out some additional content we can send out. Again, because we're very much content education driven, that it makes it easy. It's like whatever you may have, we have a podcast we can share with you, or we have this other extra webinar that we can share with you.
Yeah, I love that, because when something's new, you understand it. Like, I understand everything you're saying right now, and then I'm going to walk away, and then I'll be like, I don't remember.
Yeah.
But when you have a podcast, when you have that content, you can keep that fresh in your mind, or you can refer back to it. So if someone starts with you, what sort of support are they getting moving forward?
Yeah, it's a great question, because what we're offering is not just a product. It's not just like here, now walk away and use it. It's a system. These are strategies. So we're working with people on a regular basis. At a minimum, we meet with them once a year. So the policy anniversary date is a convenient time to get together and update, and hey, what's going on? How are you going to fund it this year, et cetera. And then during the year, they're like, hey, I'm ready to take a loan to go out and invest in this thing. Great. And we have our system in place. So we try to create a white glove service for our clients so that it makes it as easy as possible to use the strategy.
That's awesome. Well, Rod, thank you so much for coming.
Thank you.
If you guys want to learn more about Money Insights, go ahead and head to their website, or you can join us at our next live tax and asset protection event. We're definitely inviting you back.
Awesome.
We'll be happy to see you. Go to andersonadvisors.com to get your tickets. Thanks for joining us.